November 19, 2025. 4:30 p.m. Eastern Standard Time. NVIDIA CFO Colette Kress addresses investors from the company's Santa Clara headquarters, delivering financial results that will redefine the relationship between gaming and artificial intelligence forever. Total revenue reached a record $57 billion, with data center operations generating $51.2 billion, representing 90% of NVIDIA's entire business. Gaming contributed $4.3 billion, just 7.5% of total revenue. The ratio tells the story. NVIDIA's data center business now generates $12 for every $1 gaming produces. Kress's next statement would echo through gaming communities worldwide. We have evolved over the past 25 years from a gaming GPU company to now an AI data center infrastructure company. This wasn't corporate positioning. This was a declaration of war on the market that built NVIDIA. 3 weeks later, reports emerged from China's Board Channels Forum that NVIDIA plans to reduce GeForce RTX 50 series production by 30 to 40% during the first half of 2026 compared to the same period in 2025. Multiple board partners and component suppliers corroborate the cuts, targeting specific models first, the GeForce RTX 5070 and RTX 5060 16 GB. The production reduction represents NVIDIA's deliberate choice to abandon the gaming market that launched the company in favor of artificial intelligence customers willing to pay premium prices for computational power. The forensic analysis reveals how market forces, profit margins, and supply chain constraints combine to make gaming an afterthought for the world's most valuable semiconductor company. The economic mathematics driving NVIDIA's strategic pivot are brutally straightforward. An NVIDIA H100 AI accelerator sells for $25,000 to $40,000. An H200 commands similar pricing. Even lower-tier data center GPUs like the A100L40S sell for $10,000 to $15,000. By comparison, NVIDIA's most expensive gaming card, the RTX 5090, retails for $1,999. The profit margin disparity reveals the true scale of the opportunity cost. AI chips deliver 65% margins compared to 40% for gaming graphics cards. For a company optimizing shareholder returns, the allocation decision becomes mathematically obvious. Volume dynamics amplify the margin advantages beyond individual unit economics. Data center customers purchase at entirely different scales than gaming consumers. OpenAI's Stargate project alone has reportedly contracted for compute capacity equivalent to hundreds of thousands of GPUs. Microsoft, Google, Amazon, Meta, and Oracle each spend tens of billions annually on AI infrastructure, signing multi-year contracts with guaranteed volumes and accepting premium pricing. Gaming, by contrast, consists of individual consumers buying 1 or 2 GPUs every 3 to 5 years, creating unpredictable demand patterns that complicate production planning and inventory management. NVIDIA's financial trajectory demonstrates the accelerating divergence between AI and gaming markets. Data center revenue surged 66% year-over-year, climbing from $30.8 billion in Q3 2024 to $51.2 billion in Q3 2025. Gaming revenue increased just 30% over the same period, growing from $3.3 billion to $4.3 billion. In absolute dollar terms, NVIDIA's data center business added $20.4 billion in new revenue, while gaming contributed only $1.0 billion. The disparity illustrates how AI demand operates at scales that dwarf traditional gaming markets, making gaming growth appear stagnant despite healthy percentage increases. CEO Jensen Huang's public statements reinforce NVIDIA's strategic realignment around artificial intelligence rather than gaming applications. His characteristic enthusiasm about Blackwell AI chips reveals where the company's priorities now lie. Blackwell sales are off the charts, and cloud GPUs are sold out. Compute demand keeps accelerating and compounding across training and inference, each growing exponentially. Notice what's absent from his excitement: any mention of gaming developments, product roadmaps, or consumer market initiatives. The company's executive attention has shifted entirely toward enterprise customers driving exponential revenue growth. The supply chain dynamics forcing NVIDIA's production cuts expose how AI demand has overwhelmed global manufacturing capacity. High bandwidth memory represents the primary constraint, with SK Hynix and Micron, the two main HBM suppliers, having sold their entire 2025 and 2026 production capacity to AI customers. NVIDIA's decision to stop bundling VRAM with GPU dies when selling to board partners reflects the memory scarcity crisis. Previously, NVIDIA provided complete GPU solutions to manufacturers like ASUS, MSI, and Gigabyte. Now board partners must source memory independently, competing in spot markets against data center buyers willing to pay premium prices for guaranteed allocation. GDDR7 memory shortages specifically impact gaming GPU production, while AI accelerators utilize different memory technologies. The 3GB GDDR7 modules required for next-generation gaming cards face severe availability constraints as memory manufacturers prioritize higher-margin HBM production for AI data centers. NVIDIA's reported plans to discontinue RTX 50 Super refresh cards reflect the impossibility of securing sufficient GDDR7 memory for consumer products when the same manufacturing capacity can generate substantially higher profits through AI-focused memory products. Memory manufacturers' strategic decisions amplify the constraints facing gaming GPU production. Samsung is redirecting capacity from consumer DRAM and GDDR toward HBM production for AI applications. Micron announced discontinuation of its consumer Crucial brand entirely to focus on enterprise and AI markets. China's CXMT, previously a major DDR4 supplier for gaming applications, shifted almost entirely to DDR5 for data centers in early 2025. These aren't independent market responses. They represent coordinated strategic choices prioritizing AI infrastructure over consumer electronics. The production cuts will create immediate scarcity in gaming GPU markets, with predictable effects on pricing and availability. Early indicators show RTX 5070 prices increasing beyond $1,000, while RTX 5080 cards command $500 or more above original pricing. Popular gaming models are vanishing from retail channels as NVIDIA allocates limited production capacity to data center products. The gaming community faces a supply crisis entirely different from previous shortages caused by cryptocurrency mining or pandemic disruptions. This shortage results from deliberate corporate strategy rather than external market forces. AMD faces identical economic pressures despite occupying NVIDIA's traditional competitor position in gaming markets. AMD SQ3 2025 financial results showed data center revenue at $4.3 billion versus gaming revenue of just $1.3 billion. Like NVIDIA, AMD's data center business generates far higher profit margins than gaming, creating identical incentives to allocate limited manufacturing resources toward enterprise products. AMD has already implemented 10% price increases across its entire Radeon GPU lineup, citing supply constraints and component costs. If AMD were genuinely committed to capturing market share from NVIDIA's gaming retreat, price increases would be counterproductive. AMD's MI300X AI accelerator competes directly with NVIDIA's H100 for training workloads, with reported pricing around $15,000 to $20,000 per unit. The profit potential from AI accelerators explains why AMD is maintaining premium pricing on limited gaming volumes rather than flooding the market with affordable alternatives to capture NVIDIA's abandoning gaming customers. Both companies recognize that AI represents a fundamentally larger and more profitable market opportunity than traditional gaming applications. Intel's entry into discrete GPU markets through its Arc product line cannot offset the supply constraints created by NVIDIA and AMD's strategic focus on AI infrastructure. Intel's Arc GPUs target entry-level and mid-range gaming segments, but the company lacks the advanced manufacturing processes and architectural expertise required to compete in high-end gaming markets. Intel's limited GPU production capacity and focus on integrated graphics solutions mean that Arc products cannot fill the supply vacuum created by NVIDIA's production cuts and AMD's pricing increases. The gaming industry's response to GPU supply constraints will reshape how game developers approach hardware requirements and optimization strategies. Studios must now target hardware specifications that remain frozen in the 2025 era rather than assuming continued GPU performance improvements. The next 2 years will be a period of software optimization rather than hardware innovation, as developers extract maximum performance from existing GPU architectures while waiting for supply chains to stabilize and new gaming products to reach market. TSMC's manufacturing capacity allocation decisions amplify the constraints facing gaming GPU production. Taiwan Semiconductor Manufacturing Company produces over 90% of advanced AI accelerators and high-end gaming GPUs using the same fabrication processes. NVIDIA's willingness to pay premium pricing for guaranteed TSMC capacity means gaming GPU production competes directly with AI accelerator manufacturing for the same foundry resources. TSMC's rational response is allocating capacity toward customers offering the highest margins and largest volume commitments, which consistently favors AI applications over gaming products. The unprecedented gap between major gaming GPU generations reflects how AI demand has disrupted traditional product development cycles. NVIDIA's decision to push consumer Rubin architecture GPUs to 2028 creates a 3 to 4 year gap between major gaming GPU generations, a stark departure from the traditional 2-year cadence that defined PC gaming for decades. This extended timeline results from NVIDIA's choice to allocate 3 GB GDDR7 modules exclusively to AI accelerator production rather than gaming products, leaving consumers with aging hardware options while enterprise customers receive cutting-edge computational capabilities. Component pricing increases beyond GPUs illustrate how AI infrastructure build-out affects the entire PC gaming ecosystem. Storage prices have doubled as data centers consume massive quantities of NAND flash memory for AI training datasets. RAM costs have tripled as memory manufacturers prioritize enterprise applications over consumer markets. CPU prices are rising as cloud providers secure processor allocations for AI workloads. Building gaming PCs in 2026 to 2027 will cost substantially more than 2023 to 2024 for equivalent performance, creating an accessibility crisis that could fundamentally alter the PC gaming market. Alternative gaming platforms may benefit from the discrete GPU crisis as traditional PC building becomes economically prohibitive for many consumers. Handheld gaming devices like the Steam Deck utilize lower power APUs that do and compete directly with AI accelerator production. Cloud gaming services eliminate the need for individual GPU ownership, potentially accelerating adoption among gamers unable to afford high-end discrete graphics cards. Console gaming may see increased market share as PC gaming becomes less accessible due to component shortages and pricing inflation. The competitive implications for NVIDIA's gaming market position reveal how short-term profit maximization could create long-term strategic vulnerabilities. By abandoning gaming customers during supply constraints, NVIDIA risks losing brand loyalty and market share that took decades to establish. Competitor products that remain available during NVIDIA's production cuts could gain permanent footholds in gaming markets. When supply chains eventually normalize and NVIDIA attempts to re-enter gaming markets aggressively, the company may discover that customers have migrated to alternative platforms or competitor ecosystems. NVIDIA's investor communication strategy emphasizes AI growth opportunities while downplaying gaming market developments. The company's guidance for Q4 fiscal 2026 projects $65 billion revenue, driven primarily by continued Blackwell architecture momentum in data center markets. Gaming receives minimal attention in investor calls and financial guidance, reflecting management's view that gaming represents legacy business rather than a growth driver. The strategic messaging signals to investors that NVIDIA's future depends on AI infrastructure rather than traditional graphics applications. The regulatory implications of NVIDIA's gaming market retreat could attract antitrust attention as the company achieves near-monopoly positions in both AI accelerators and high-end gaming GPUs. NVIDIA's discrete GPU market share has expanded to 94%, creating potential competition concerns as the company simultaneously reduces gaming product availability. Government officials monitoring AI infrastructure development may question whether a single company should control access to both enterprise AI capabilities and consumer computing platforms. Industry consolidation may accelerate as smaller component manufacturers face supply chain pressures created by AI demand. Graphics card manufacturers like EVGA that already exited NVIDIA GPU production may be joined by others unable to secure memory allocation or manage inventory risks. Board partner companies face increasing pressure as NVIDIA shifts responsibility for memory sourcing to manufacturers while providing fewer complete product packages. The gaming hardware ecosystem could contract significantly as companies choose to focus on more predictable business segments. The long-term implications for PC gaming culture extend beyond hardware availability to fundamental questions about platform sustainability. Gaming enthusiasts who drove GPU innovation for decades through willingness to pay premium prices for cutting-edge performance may find themselves priced out of markets they helped create. The democratization of high-performance computing through gaming may reverse as computational resources become concentrated in enterprise data centers rather than individual consumer systems. Emerging technologies like AI-driven upscaling and frame generation may provide temporary solutions to stagnant hardware performance, but these software optimizations cannot substitute for fundamental improvements in GPU computational power. Technologies like DLSS 5.0 and neural rendering become necessary adaptations to hardware constraints rather than value-added features enhancing gaming experiences. The burden of innovation shifts from hardware manufacturers to software developers who must extract maximum performance from increasingly outdated GPU architectures. The economic implications for game development studios reflect how hardware constraints affect software business models. Developers targeting high-end graphics capabilities face shrinking addressable markets as fewer consumers can afford cutting-edge GPU hardware. Studios may need to focus on optimization for older hardware or explore alternative platforms that don't require discrete GPU performance. The economics of game development could shift toward titles optimized for integrated graphics, cloud gaming platforms, or mobile devices rather than traditional discrete GPU gaming systems. Educational and research institutions that rely on gaming GPU hardware for computational research face significant challenges, as these products become unavailable or prohibitively expensive. Universities and laboratories that used consumer graphics cards for scientific computing applications must either migrate to expensive data center products or accept reduced computational capabilities. The democratization of computational research through affordable gaming hardware may end as the same hardware becomes exclusively oriented toward enterprise applications. The psychological impact on gaming communities reflects the frustration of enthusiasts who supported NVIDIA through decades of market development, only to be abandoned when more profitable opportunities emerged. Gaming communities that celebrated NVIDIA's technological achievements and defended the company against competitors now face the reality that their market segment has become peripheral to corporate strategy. The emotional connection between hardware enthusiasts and brands may weaken as companies prioritize financial metrics over community relationships. NVIDIA's strategic transformation from gaming GPU company to AI infrastructure provider represents a fundamental shift in how the semiconductor industry views consumer versus enterprise markets. The company's willingness to sacrifice gaming market share for AI profit margins demonstrates how technological breakthroughs can rapidly reshape competitive priorities. Gaming built NVIDIA into a technology leader, but artificial intelligence now drives the company's future growth and strategic focus. The reckoning is financial and strategic. NVIDIA's 40% gaming GPU production cuts mark the definitive end of an era where consumer gaming drove GPU innovation and corporate strategy. The mathematical superiority of AI margins over gaming profits means that production capacity will flow toward enterprise applications regardless of consumer preferences or market sentiment. Gaming enthusiasts face the harsh reality that their purchasing power cannot compete with enterprise customers offering guaranteed volumes at premium pricing. When infinite AI demand meets finite manufacturing capacity, consumer markets become collateral damage. NVIDIA's transformation from gaming champion to AI infrastructure provider illustrates how technological revolutions can abandon the communities that enable their success. The autopsy is complete. The diagnosis is market evolution. Gaming built NVIDIA's technological capabilities, but artificial intelligence has made gaming economically irrelevant to the company's future. The only question remaining is whether gaming can survive as a platform when the companies that enabled its golden age have moved on to more profitable opportunities.